Welcome to this in-depth stock market news breakdown where we'll be comparing three high-profile stocks: SoFi Technologies, SoFi, Adobe Incorporated, Adbe, and Pypl Holdings, Pypl. All three companies operate in distinct sectors of the economy, from fintech disruptors to software giants, and are popular stocks for investors looking for growth potential. In this video, we'll take a deep dive into the recent performance of each stock, analyzing their financials, growth prospects, risks, and potential market challenges ahead. Whether you're an investor in any of these companies or just curious about the stock market landscape, this detailed comparison will give you valuable insights. SoFi Technologies, SoFi Fintech Growth and Disruption. Let's kick things off with SoFi Technologies, one of the most talked about fintech disruptors. SoFi started as a student loan refinancing platform but has since expanded its services to offer personal loans, home loans, credit cards, investments, and even banking services through its mobile app. The company is positioning itself as a one-stop shop for financial services, which appeals to younger, tech-savvy consumers. Recent stock performance. As of the latest updates, SoFi has been experiencing significant volatility. Over the past year, SoFi's stock has seen some impressive rallies, largely due to its strategic acquisitions, including its purchase of Galileo Financial Technologies and its national bank charter approval. These moves have enabled SoFi to broaden its offerings and, importantly, improve its lending margins by holding deposits directly. However, it's important to note that the fintech space is extremely competitive, with SoFi up against major traditional financial institutions and fintech companies like Square, Robinhood, and even PayPal. Financial overview. From a financial perspective, SoFi is still in growth mode, meaning the company is not yet consistently profitable. While revenue has been growing at a rapid pace, driven by an increasing number of users and a diverse set of financial products, the company is still reinvesting a significant portion of its earnings into growth initiatives. SoFi's adjusted EBITDA has improved in recent quarters, showing signs of profitability on the horizon, but they remain in a cash burn phase. The biggest challenges facing SoFi are its profitability timeline and the pressure to maintain user growth in a saturated fintech market. Investors are also watching closely how SoFi manages to balance its growth with regulatory hurdles, given the company's recent approval to operate as a national bank. Growth prospects. Despite these challenges, SoFi's growth prospects remain promising. It's tapping into a massive market by targeting millennials and Gen Z consumers who prefer digital banking over traditional brick-and-mortar institutions. Additionally, SoFi's financial products are diversified enough to hedge against economic downturns in any one area, e.g., student loans. With the full rollout of its banking services, SoFi has a solid chance to reduce costs, improve margins, and provide a comprehensive platform that attracts long-term customers. Adobe Incorporated, Adbe, the software giant's dominance. Next up, we have Adobe, a titan in the software industry. Adobe's stock has long been a favorite among tech investors, thanks to its dominance in creative software and digital marketing tools. The company's flagship products like Photoshop, Illustrator, Premiere Pro, and Acrobat have made Adobe indispensable to creative professionals and businesses alike. Additionally, Adobe's growth into the cloud and subscription services has fundamentally transformed its revenue model and kept it at the forefront of the software industry. Recent stock performance. Adobe's stock has experienced consistent growth over the last decade, reflecting the company's strong financials and market dominance. In 2023, however, the stock faced headwinds due to macroeconomic factors like inflationary pressures and concerns about rising interest rates impacting the broader tech sector. Nonetheless, Adobe's stock remains highly valued, with analysts pointing to its leadership in creative and marketing software as a key reason for its resiliency. Financial overview. Adobe's financials remain impressive. Its transition to a subscription-based model via Adobe Creative Cloud and Adobe Document Cloud has led to a steady stream of recurring revenue, which investors love. In its most recent earnings report, Adobe reported double-digit revenue growth, with strong operating margins above 30%. The company generates significant free cash flow, allowing it to fund strategic acquisitions and research and development, all while maintaining robust stock buyback programs. One of the key risks to consider with Adobe is its valuation. The stock trades at a premium compared to other tech stocks, largely because of its market leadership and consistent growth. If the broader tech market faces a correction or if competition in digital marketing intensifies, Adobe's stock could be vulnerable to a pullback. Growth prospects. Looking ahead, Adobe's growth prospects appear strong. The company's push into the AI space with tools like Adobe Sensei, which powers intelligent features across its platforms, is expected to drive future growth. Additionally, its acquisition of Figma, a popular design tool, will not only complement its existing suite of creative software, but also give Adobe a stronger foothold in the collaborative design and web development space, appealing to a broader audience. Furthermore, the digital marketing side of Adobe's business, which includes its Adobe Experience Cloud, continues to grow as businesses invest in personalized digital marketing strategies. As digital transformation accelerates globally, Adobe stands to benefit from companies across industries that need robust tools for content creation, marketing, and analytics. PayPal Holdings, PYPL, the evolution of a payments giant. Finally, we turn our attention to PayPal, one of the pioneers in digital payments. PayPal has undergone a transformation from being a simple online payments processor to a full-fledged fintech powerhouse, offering peer-to-peer transfers via Venmo, digital wallets, cryptocurrency trading, and even buy now pay later services. Recent stock performance. PayPal's stock has had a turbulent couple of years. After a meteoric rise during the pandemic when digital payments and e-commerce boomed, the stock has since faced considerable pressure. Investors have become increasingly concerned about slowing user growth, intensifying competition in the payment space, and the company's ability to maintain its leadership as newer entrants like Block, formerly Square, Apple Pay, and Google Pay gain traction. Financial overview. Despite these concerns, PayPal's financials remain robust. The company consistently generates solid revenues, with strong transaction volume growth across its platforms. In its most recent earnings report, PayPal saw modest growth in total payment volume, TPV, though the rate of growth has decelerated compared to previous years. PayPal's profitability is still a bright spot, with healthy margins and significant free cash flow generation. However, the biggest challenge PayPal faces is maintaining its competitive edge. The fintech space is becoming increasingly crowded, with large tech firms like Apple and Google offering alternative payment solutions. Additionally, PayPal's Venmo platform, once a major growth driver, has seen user growth slow as competition in peer-to-peer payments intensifies. Growth prospects. Despite these challenges, PayPal remains well-positioned to capture growth opportunities. The company's foray into cryptocurrency is expected to pay off in the long term as more users become comfortable transacting with digital assets. Moreover, its buy now pay later, BNPL, offering is another growth area, as more consumers seek flexible payment options for online purchases. One key area to watch is PayPal's partnership strategy. PayPal has forged alliances with companies like Amazon, allowing users to pay via Venmo on Amazon's platform, which could open up new revenue streams. Additionally, PayPal's focus on growing its merchant services and expanding into underserved international markets could provide significant long-term growth opportunities. Conclusion. Which stock is the better buy? Now that we've looked at all three companies, let's address the big question. Which stock is the better buy? SoFi is an exciting growth play in the fintech space, with a strong vision of becoming a leading digital financial services provider. However, it carries higher risks due to its lack of profitability and exposure to regulatory hurdles. Adobe, on the other hand, is a well-established tech giant with a dominant market position, steady revenue growth, and strong profitability. For investors seeking stability and exposure to cloud-based software and creative tools, Adobe is a solid long-term choice. PayPal sits somewhere in between. While it's facing increased competition, it remains a strong player in the digital payment space, with exciting growth potential in cryptocurrency and BNPL services. Ultimately, the right investment depends on your risk tolerance and investment horizon. SoFi offers the highest risk and reward, Adobe is the safer, long-term bet, and PayPal provides a balance of stability with potential for future growth. Thanks for watching. Be sure to like and subscribe for more stock market news and updates.